Welcome back. You're with us on Closing Bell, and we're looking at global markets because things are a little volatile with a negative bias. Most of the European markets are down between 1.5% to a little over 2% in some of the peripheral markets like Italy, for instance. And this impasse on the US debt ceiling seems to be really playing on everyone's mind. There you go, 1.7% lower on the CAC now. We have Craig Erlam, senior market analyst at Wanda now with us. Craig, thanks very much for taking this call. I guess up until a day or two back, global markets were taking all this chatter on the debt ceiling, all of this, political posturing in their stride. But now things seem to be changing. What exactly is the market pricing in at the moment? And do you expect more volatility?
I think it's a combination of factors. The debt ceiling is front and centre right now, but I don't think anyone seriously thinks that's going to go badly. We may see the deadline pushed back from the 1st of June. There's a lot of talk now about the 6th of June, so we could see negotiations last a little bit longer, but we're not going to hit the debt ceiling. There's going to be no default. That would be a catastrophic piece of self-harm from the US. And it would have ramifications for global markets and long-term implications for the US as well. So that's not going to happen, but we could potentially see that play a little bit into risk appetite in the broader markets, just pricing in the risk of what if rather than the risk of what's likely. I think there's a good thing that's playing a role at this point in time, and we've had a little dose of it today in the UK. We are seeing signs that inflation could be a bit stickier, and the UK inflation data today not only showed that headline inflation didn't fall as far as expected, but it actually showed that core inflation rose unexpectedly by 0.6%. And when you combine that with some of the more hawkish commentary you've had from certain central banks, with the commentary from some central bank policymakers in the US talking about 2 more rate hikes rather than a rate pause, then suddenly we're in a situation where I think investors are trying to square this circle of how much more tightening is there going to be? What is going to be the economic ramifications? And is current forecast too optimistic about interest rates later on this year going into next? Is this going to be a longer-term problem? And that, I think, is what's really tipping the balance currently.
In fact, even former,
Sorry, Eric said, sorry to interrupt, but Eric said there's a what-if question, right? There's a very popular book called What If. It has it answers ridiculous questions like what if the oceans all dry up together? What if the moon comes closer to the Earth? And what if computers take? I mean, not all ridiculous questions, but outlandish questions. And I think
computers taking over the planet is already happening, Prashant.
The question, what if the US defaults? I think fits right. Exactly there. I mean, I remember in 2004, 2005, when I started, first heard this question, someone said, well, we can all head to the hills if the US defaults. It's never happened before. They've always honored their debts. And I think Eric is absolutely right that no one in this right mind seriously thinks that's going to happen this time around as well.
So, Eric, the bigger concern right now... Craig, sorry. Craig, do you think the bigger concern right now is the possibility that in the June Fed meeting, we are not going to get a pause? Because yesterday, we had former Fed Chair Ben Bernanke also saying that the central bank has more work to do to control inflation. So do you think that's the bigger worry for our markets, that even once we get a resolution on these debt ceiling issues, markets will still be a bit nervous?
Yeah, I think it is. It's not just June as well. I mean, June we could get a pause, and then the following meeting we could get a hike. I think there's always a lot of focus on the next meeting, looking for strong signals. But for me, the most important thing is the next 2 or 3 months. And the reason is we're now at the anniversary, or just gone past the anniversary of the invasion of Ukraine. And that's when we saw, obviously, a lot of movements in commodity markets, etc. We've seen a lot of inflationary impacts of that. And therefore, now that we're starting to get the April, then the May and June data through, that's when we start to see more favourable base effects. So the surge in commodity prices start to fall out of the equation. And we start to see what real inflation is, longer-term inflation is looking like, and how stubborn it is, and how more ingrained it is. And it's the ingrained aspect which I think is going to become much clearer in the next 2 or 3 months. And I think that plays into the anxiety that we have here, is that if, like we're seeing, for example, today from the UK data, if it looks as though this is something that's becoming a little bit more ingrained, then that has massive implications in terms of what kind of growth prospects we have and how long interest rates have to stay high for. There's a lot of focus on the terminal rate of interest rates, but for me, it's the time factor. There's a big difference between what the markets have been pricing in, which is the terminal rate for 2 or 3 months and then ongoing rate cuts going into 2024 and 12 to 18 months of a terminal interest rate, which, if inflation remains sticky, is something that could become a potential outcome. That could have massive ramifications as far as the global economy is concerned. And that's the part that I think is really troubling investors and will do for the next couple of months.
Oh, absolutely, Craig. For a lot of investors, it was sort of a happy, understanding that we go into a bit of a pause and then you start looking at rate cuts. But if inflation continues to be sticky, then you are in for a disappointment there. Just finally, before we let you go, from where you see things in your part of the world, is China a talking point at all? Is that another issue that we need to perhaps put on the worry list because of the high COVID cases there, and B, even if you're looking at commodities, metals for that matter, there's a lot of price destruction that's going on because it seems that the reopening, buzz and the reopening expectations, the reality is not as strong as what those expectations seem to put on the table.
Yeah, with China, there's a number of different focal points really that we can look at, and there's also different knock-on effects from what could come from it. So, if you just take the reopening as an example, we were expecting it to be quite strong, and it turned out initially to be even stronger, and then it seems to have cooled very quickly. Now, there's two implications to that. One of which is lower growth means that we're not going to see that supportive growth force for the global economy. But the other side of it is on that demand side, at least in the short term, is that we could see lower demand for commodities and therefore lower potential inflationary pressures, although we are seeing still a lot more focus on the services side of things. So that's one aspect. Then there's the other aspect, which is the relationship with the US. Of course, we're seeing still these kind of tech-focused tensions between the two. What impact does that have in terms of growth, in terms of the kind of global cooperation? And then, of course, there is what we've seen more recently, which is its relationship with Russia. We're almost seeing this global divide into powerhouse nations, into two large teams, as it were, with China coupling up with Russia and Iran, etc., and then the US and elsewhere. What does that mean for globalization? What does that mean for global growth prospects? Because deglobalization, in its very nature, is a growth dampener, and therefore that's a big thing with China as well. So there's so many different angles with China right now, starting with growth, but also everything else which we've just touched on, all of which seem to nod towards being weaker as far as growth prospects are concerned.
Okay, all right, Craig, thanks so much for stopping by and giving us your quick take on how the entire global dynamics are panning out. On the Nifty, we continue to trade below that 18,300 odd mark. A few stocks, though, are moving around.